The Federal Reserve is kicking off a two-day meeting today that will end with an interest rate hike announcement.
That's right. Like it or not, some on Wall Street fear that after last week's inflation report, it may prompt the Fed, I should say, to be even more aggressive than it originally signaled. You see, earlier this month, Federal Reserve officials indicated June's rate hike would be half a percentage point. But that sentiment changed after Friday's CPI report showed a bigger jump than expected in inflation. And so now investors and businesses are waiting to see if this month's rate hike will be larger than expected.
So Mark Hamrick, senior economic analyst and Washington bureau chief for Bankrate, joins us now. It's great to have you here. So tell us, we were anticipating 50 basis points. Now some people are saying 75, maybe even higher. What do you think the officials will announce at this meeting? And how much do you think that this will actually help inflation?
Well, first of all, we have to think about why the Federal Reserve, Alana and Errol, is doing this, and that's because inflation is out of control at the highest levels in 40 years. It's the primary concern of most Americans when it comes to the economy. It's having real impacts on households and their budgets, particularly those with lower incomes, lower wealth, even middle incomes and sort of middle wealth households as well. So with respect to the actual size of the rate increase, I don't think it's an accident that this has been trotted out through reporting in the last 24 hours. It clearly is going to be on the table. And if we get that 0.75% move, you can look at that as a stronger dose of medicine for this heightened inflation and rising inflation expectations, which is also something the Federal Reserve watches. Of course, this is immediately transmitted onto banks, which then raise their prime lending rates, the rate that they charge their best customers, and is reflected in variable lines of credit. And the way that that shows up for most Americans is higher rates to use a credit card.
Another area we're seeing the impact of increased interest rates is the housing market. It seems to slightly be cooling. It isn't crashing, it isn't dead, but we're not seeing the same rate of mortgage applications being submitted than we did even 3-4 months ago. The last time the Fed raised rates this high, if it was 0.75%, was back in '94. Everyone knew that was coming. It seems as though everyone knows this is coming, but it will factor a lot on how this is messaged, which dictates how it will land. So what's your guidance for what the messaging should be in order for the right parts of the economy to cool and inflation to be tempered?
Well, I think Federal Reserve Chairman Jerome Powell is pretty good at plain speaking. And so that's one reason why we look forward to the news conference that I'll be attending in the coming day. And I think that in terms of what they want to achieve, listen, they have a dual mandate that's prescribed by law. That's stable prices and maximum employment. They believe they've checked off the job market piece of that, and they know that essentially they're behind the curve on inflation. So that's why they will be pondering this higher dose of medicine that we discussed earlier. The housing market is cooling. We see mortgage applications, as you note, at the lowest levels in years, and yet mortgage rates are also at the highest levels in years. The benchmark 30-year fixed above 5%. Some would have said the housing market was too hot. Chairman Powell has said the job market is too hot. And so these are some of the impacts we're seeing. Of course, the volatility in the bear market in stocks is another real impact. So we're seeing wealth destruction now, whether it's in the stock market, retirement savings, and of course the impacts on cryptocurrency that some thought was just an accident waiting to happen anyway.
Wealth destruction, that sounds ominous.
Yikes. Mark Hamrick, thank you very much. Appreciate it.
Thank you.